Good morning, everybody. This is Erik Daly from Miller Johnson. I am a partner in our business section. I'm joined today by my colleague Loic, who is also a business section and corporate department member. Happy Monday morning. I hope everybody enjoyed their weekend as much as they could, given everything that's going on in the world right now. But I hope folks were able to spend some time with family, loved ones, or to recharge on their own. Getting back into our continuing webinar series this Monday morning, we will be talking about the Main Street Lending Program, or programs that were announced last Thursday by the Federal Reserve and Treasury Department as part of the implementation of the CARES Act, which was signed into law, I think about 16 or 17 days ago now, 2 Fridays ago, 3 Fridays ago now, I guess. In any case, before we jump into the subject and the substance of that discussion, we always start our webinars with kind of a quick rundown of latest developments as it relates to the coronavirus COVID-19 situation, both here in Michigan, where we are, as well as beyond that part of the country. And then also kind of reminding ourselves what our principles are in working on this with clients and other members in the community. So in terms of latest news developments, in Michigan right now, where we are, we have about 25,000 confirmed cases of COVID-19 with about 1,500 deaths, sadly. There was some news reporting yesterday that those numbers of new confirmed cases and deaths had declined pretty significantly in one day. The state went out of its way to point out that might have been and probably was anomalous because of fewer tests being done over that weekend in particular, this most current weekend, and that they've seen meaningful dips in weekends prior, and that would be especially pronounced over a holiday weekend. So hopefully the trend is in that direction, although it may not be, and it may not be that significant if it is, but that's where we are in Michigan right now. In the U.S. as a whole, there are over 555,000 confirmed diagnoses of COVID-19 with over 22,000 deaths, unfortunately. And then, of course, the global situation is worse than that, with nearly 2 million confirmed diagnosed cases and over 100,000 deceased patients. So obviously it continues to be a bad situation, and it's impacting all aspects of our lives. Through these webinars, we're trying to work with the community and our clients here in Michigan and beyond to understand the legal ramifications of all this. So we will continue to do that. There's a few other bits of news which I think are a little bit more encouraging, which I'll just touch on briefly. One is that Apple and Google have come together remarkably to launch a joint coronavirus tracing system through both iOS and Android platforms. So that'll be an interesting thing to watch, to see how that develops as we move into hopefully a next phase of this kind of new reality that we're living in, where we can leverage some technology to help identify those who may be at higher risk, or those who are at lower risk, or may have already had the coronavirus, the COVID-19, even though they didn't get diagnosed at the time, so that we can have better insight into everybody's more unique situation and tailor our approach accordingly. So that'll be something very interesting to watch, and I'm hopeful that technology providers and others will continue to leverage their capabilities to help move us forward along with government and business. So with that said, I like to just, after the news segment every morning, just going to remind us that at least at Miller Johnson, our principles, and I think in our community in general, are ingenuity, collaboration, candor, intellect, and loyalty in proceeding with our approach to responding to this situation. And that's the approach we'll continue to take today and through this week as we try to help out as much as we can. And I know the audience members try to do what they can to contribute to continued positive developments. So with that, why don't we get started on the substance? Move forward to the next slide. So the topic today, again, is anticipated terms of this Main Street lending program. And I want to emphasize that these are the anticipated terms of the program. The Federal Reserve, when they announced the high-level kind of overview of what they envision this program will look like, really just put out a press release. And really the Main Street lending program was just one part of that press release. There were several other lending facilities, which are beyond the scope of this presentation, that were addressed in that press release as well. And then there were a couple of term sheets for the Main Street lending program. And that's what we're going to talk about today. They're not final term sheets. And as we get into this presentation, you'll see that we have a number of areas where we think there will need to be more detail provided. So similar to those who may have been kind of tracking the Paycheck Protection Program through its development from bill to law to implementation through regulation and FAQ, I think we'll just take all this as anticipated terms, and we'll see what happens as public provide feedback and Fed finalizes the terms and starts to actually implement certain aspects of this with the bank participants. And at the outset here, we have our pretty typical disclaimer that this is not legal advice. This presentation is not legal advice, and it doesn't create an attorney-client relationship. So if you have additional questions, one, I would encourage you to track continued development of the program terms, but also to reach out to counsel, whether it's at Miller Johnson or somewhere else, to make sure you're understanding what the program terms are. So with that, why don't we keep moving? Okay, so the Main Street lending program, as I mentioned before, is part of the CARES Act implementation. In the CARES Act, the U.S. Treasury was appropriated $500 billion to make loans, loan guarantees, et cetera. About 46 billion of that 500 billion was earmarked for the airline industry and air cargo carriers, as well as national security companies. Probably Boeing was not called out specifically by name, but that was one of the likely targets for that. So when you take those 46 billion in appropriations out of the 500 billion, you end up with 454 billion left for the Treasury to make loans, loan guarantees, and other investments to facilitate support for eligible business, states, and municipalities. On April 9th, I think last Thursday, forgive me if I've lost track of which day exactly it was, but I think it was on April 9th, the Fed announced its commitment to purchase up to 600 billion in loans made through what will eventually be this new Main Street lending program when the terms are finalized. And the Treasury Department announced that it would be using 75 billion of that remaining 454 billion referenced in the first bullet point above to make an initial equity investment in a new special purpose entity that would then receive loans from the Fed to facilitate lending by banks. So essentially what you have happening is Treasury using $75 billion of its appropriations to facilitate the Federal Reserve providing a multiple amount of that up to generate up to $600 billion in loan participations through U.S. banks, basically. So they're leveraging that $454 billion appropriation into a larger program. And one thing I just note on that is that the Fed and Treasury seem to have made it clear that this program is not direct lending under the CARES Act, which is significant for a few reasons. One seems to be, and we'll see if this is how it plays out as the program terms are finalized, seems to be that the certifications, some of the certifications which would have otherwise been required under a direct lending program for mid-sized businesses are not presently included in the loan certifications for this Main Street lending program. And I think maybe most notably, those related to not abrogating CBAs and remaining neutral in any union organizing efforts. Those certifications are sort of conspicuously absent from the term sheets, as well as limitations on not offshoring jobs and more objective requirements for maintaining employment and compensation levels, all of which would be required under a direct lending program under the CARES Act, but the Fed is positioning this with Treasury as not direct lending. So that is a bit of a substantive result from the way they've opted to formulate this program. Let's go on to the next slide, please. So the Main Street New Loan Program and the Main Street Expanded Loan Program are two separate parts of one overall Main Street lending program. They both have similar goals and largely the same terms. There are a few differences between the programs. Conceptually, the most important difference is, and it's maybe evident through the names of these subprograms, but the new loan program is meant to support new loans. So a borrower who's otherwise eligible can take on a totally new loan. It would go through a U.S. bank to do so, and certain terms would be required under this new Federal Reserve program with the Treasury to make it an eligible loan for the Fed to help fund and purchase a participation in it. And then the Main Street Expanded Loan Program is really more for borrowers who already have a credit facility in place with a lender or potentially a group of lenders, and is looking to increase its borrowing capacity under that existing borrowing arrangement, and to have these favorable terms that are part of the Main Street lending program apply to that, what we'll call an upsized tranche or upsized portion of that newly expanded loan. So that's the key difference. One is totally new loans, and the other is an expanded upsizing or a new portion of an existing loan. And both here are meant to support small and mid-sized businesses that were in good financial standing before the crisis. And that wording, in good financial standing, is taken from the Fed's press release. There's not a lot of detail provided in the term sheets around exactly what that means, but it's significant, I think, because unlike the Small Business Administration's Paycheck Protection Program and Economic Injury Disaster Loan programs, where they've completely done away, other than maybe checking your credit score for an EIDL, they've more or less done away with any kind of underwriting or what they call credit elsewhere testing to see if the borrower is eligible for obtaining credit from another source, it appears that there will be some financial health underwriting as part of this program. And certainly, if nothing changes with the program terms, there will be some indirect limits as we'll get to, just in terms of loan size availability based on EBITDA over in 2019. So, for example, a business that had negative EBITDA probably is not going to be able to take advantage of this program. So there's indirectly built into the formulas for loan size and things like that already some tests for financial good standing, but I think we can anticipate that there will be more discretion for banks to either fund or deny new loans or expanded loans based on the financial wherewithal of the loan applicant under this program. And another important point here is that there is, and we'll get to this later, there is a certification required from the would-be borrower about the impact of COVID-19. And the wording for those who followed the Paycheck Protection Program certifications, the wording is a little bit different for this certification under the Main Street Lending Program than under the PPP. So we'll get to that later, but there will be some requirement to certify that the COVID-19 implications and impacts have made the loan necessary, and then ties that necessity to using certain of the funds for retaining employees. So let's keep moving. So I touched on this already, but just in a little more detail here. The way this program will work is that the Federal Reserve will lend to this new special purpose vehicle on a recourse basis. So the SPV will basically, and the SPV is funded, again, part by Treasury with $75 billion of so-called equity investment, and then the rest in lending from the Fed. The SPV will purchase 95% participation interest in eligible loans under the program. So that, just to pause on that briefly, if the SPV is able to purchase up to $600 billion in loans, according to the announcement of this program, and it's purchasing a 95% participation, that means the actual overall size of the program, when you include the 5% that the banks are going to keep on their books, is actually closer to $630 billion. It's just $600 billion coming from the Fed, the SPV set up by the Fed and Treasury. So when you look at the overall size of this program, it's actually a little bit bigger than $600 billion, just because that portion, I think, that banks are keeping on their balance sheet has not participated from the SPV will be incremental to that $600 billion, I think is the way this will work. But in any case, they're going to share the risk. The new SPV and the bank lenders will share risk for each of these loans on a pari passu basis. So, you know, if basically the Fed will be bearing the Fed and Treasury will bear 95% of the risk on these loans, and the banks about 5% on the loan. So they will continue to have some exposure here, hopefully unlike in the Paycheck Protection Program, where those loans are, if they're extended properly and the banks don't take shortcuts in how they make the loans, those loans should get the benefit of a 100% federal guarantee. Effectively, there's a 95% participation here from the federal government in the Main Street Lending Program. So let's go to the next slide, please. Okay, we touched on this already a bit as well, but the Main Street Lending Program really has two sub-programs. The first is new unsecured loans to eligible borrowers, and that could be a borrower that has no other credit arrangements in place or borrowing arrangements in place today. Or I suppose it could be we'll see when this gets fleshed out, but I could be a borrower that does have an existing borrowing facility in place, but has sufficient basket room for permitted indebtedness to allow for some additional unsecured lending under this type of program. That may be a pretty rare instance without at least having to get some kind of a consent, but it's conceivable at least that some borrowers would be able to take out, for example, a smaller new loan under the Main Street lending program rather than seeking to expand upon a pre-existing lending arrangement that it has. And there could be reasons for doing that, which we can touch on later, but I just wanted to mention that possibility. And then the Main Street expanded loan program, again, this is really more for your borrowers that do have existing, whether they're secured or unsecured loan facilities. They do have those facilities in place already, and the new financing there would be an upsizing of the existing loan facility, and that upsized portion at least would be on the terms set by the Fed and Treasury, which we'll go through in slides shortly. And on the expanded loan facility, there's no requirement if the initial loan was secured, say, there's no requirement to pledge additional collateral. But the Fed term sheet is clear that if there is existing collateral, it will be shared both as to the pre-existing loan arrangement that's already in place and as to the newly expanded or upsized portion of the loan, so that the collateral package that exists would apply to both parts of the loan after giving effect to Main Street lending. And it also does, the term sheet does also reference the possibility, at least, of additional collateral, which is interesting because it's not totally clear, whether that would need to be just assets of the same borrower group or if it could include assets of additional entities or some kind of, even potentially some kind of a guarantee from an owner or a sponsor. So I think it'll be interesting to see if that gets clarified more. Or if the banks are given discretion to require those types of things as they're originating upsized expanded loans under the Main Street lending program. Let's go to the next slide, please. So on the lender side, eligible lenders under both Main Street lending programs or sub-programs will be U.S. insured depository institutions, U.S. bank holding companies, and U.S. savings and loan holding companies. That's significant because non-bank lenders are not included. So if any are non-traditional lenders that have emerged especially over the last 5-10 years, those are not going to be eligible lenders unless something changes under the program. And then also non-U.S. lenders. So if you have an existing arrangement with a non-U.S. bank, they would not be an eligible lender the way the program is currently positioned. So that's potentially significant for borrowers whose current arrangements are with lenders of that type, because it may impact, it likely will impact their ability to take advantage more easily, at least, of these programs. It'll be harder to get a new loan unless you clearly have, space within a basket under your existing loan, and it'll be harder to get, if not impossible, to get an expanded loan without, pretty significant consents and restructuring because your bank wouldn't be an eligible lender under the program. So that'll be another interesting thing to track. And then it's also unclear whether, if you have a syndicated loan, whether the whole syndication, whether the whole lender group has to qualify as an eligible lender, or if there's some flexibility there. For example, if you have a lender group and only one of the lenders is ineligible, can the eligible lenders provide the financing through the Main Street Lending Program, or does one ineligible lender kind of make it impossible for the whole group to participate? Hopefully, there'll be some reasonable guidance on points like that. And overall, I would just observe that the term sheets that were released by the Fed last Thursday really, they seem to implicitly envision that they apply to a single borrower, single lender type of financing arrangement, whereas in reality, many, if not most, of the companies who would be looking at these types of borrowing programs will have multiple borrowers and may have multiple lenders. And so the devil is obviously in the details for those types of situations. And I think it's just important to remember again that what was put out last Thursday by the Fed is really kind of in my mind, a starting point for this program. There's really no statutory guide rails for what they can do here. There's a lot of authority granted to the Fed in the CARES Act. It's really just one paragraph saying that they're allowed to set up this Main Street Lending Program. And there's a little bit of guidance in terms of having to comply with other statutes, but they've got a lot of latitude for what they do here. And that, to distinguish it again from the Paycheck Protection Program, which was spelled out in much more detail in the statute, and even there in the PPP context where there was a lot of detail, the program implementation ended up deviating a fair amount between the actual language in the statute and the initial announcements from the Senate and Congress, and then what borrowers ended up or are currently kind of experiencing as they go through that process. So just I guess another word of warning that things may well change here, because I don't think the term sheets really envision all the issues that are going to come out of this. Let's keep going to the next slide. So before I hand it off to Loic to go through some of the key loan terms, there are attestations that lenders need to make as part of this program. And essentially what they come down to on the first couple of points is that the proceeds of the loan won't be used to repay or refinance existing loans or lines by that lender to that borrower. So you can't use a new loan under the Main Street Lending. You can't use any loan under the Main Street Lending Program to pay down pre-existing debt. And the other second attestation, which kind of goes hand in hand with that the lender will not reduce any existing lines of credit or borrowing availability, basically. So that the idea is that this is all meant to be incremental financing, not used to reduce or somehow limit access to pre-existing financing. One thing that's not clear from the term sheets is whether or to what extent the borrower must first use available financing that predated the Main Street Lending Program versus being able to use the potentially more favorable Main Street Lending Program financing first, and then having its pre-existing debt as sort of a secondary option. And so that will be interesting to see if that gets clarified more in the guidance that comes out or the updated program terms. I think probably most borrowers would, for example, if they're taking on an upsized portion of an existing lending facility, it may be that it's preferable to be able to use that portion first, just based on the current terms versus, the pre-existing terms of their current debt. But we don't have any answers on how that will work yet. And then the last certification or attestation that we included on the slide is really just it's a certification that the borrower is eligible under the program, which actually is a pretty significant certification and requires some due diligence, I think, on the lender side, just to make sure that, especially as to the conflict of interest prohibitions for ownership by senior federal government officials, which would extend down to members of Congress, that they're not tripping up that requirement. So to what extent the lender has to satisfy itself that the borrower is eligible, I think may also get further clarified, because if I were in the shoes of a lender, it would be potentially difficult for me to certify without making pretty meaningful due diligence, including financial due diligences we'll get to based on the program terms, that the borrower is an eligible loan recipient. So we'll see what happens there. So that is potentially a pretty significant attestation by a lender. And with that, I will hand it over to Loic to talk a little bit more about the borrower side of things.
Thanks, Erik, and thank you everyone for joining us this morning. With regards to eligible borrowers, there's really two sets of criteria to be eligible. First, the borrower must be a business with up to 10,000 employees or up to $2.5 billion in 2019 annual revenue. As Erik mentioned, there's still a lot of gray area and a lot of uncertainty, and with regards to this criteria, it's unclear how the affiliation concepts will apply in determining, both total employees and the total 2019 annual revenue. One thing that is probably worth noting is most traditional forms of financing require some level of auditing for one's revenues or other financials. It's, again, unclear to what extent a borrower will have to establish their 2019 annual revenue for purposes of determining eligibility. In addition to those requirements, an eligible borrower must also be created or organized in the U.S. or under U.S. laws and have significant operations and a majority of its employees based in the U.S. Again, what constitutes a significant or a majority of operations and employees is unclear, and something that we hope to get further guidance on moving forward. One thing that an eligible borrower may not do is they cannot participate in both Main Street loan programs. And so you've either got the Main Street new loan program or the expanded loan program, one or the other. And then also, Erik mentioned a number of the other loan programs that were created or announced on the April 9th notice. One thing that should be noted is that if you participate in one of these Main Street lending programs, is you would be prohibited from participating in the primary market corporate credit facility and vice versa. So if you choose to make use or take advantage of that program, you would not be eligible for one of the Main Street lending programs. One thing that is convenient, though, is that one may take advantage of this program, a Main Street lending program, and the Paycheck Protection Program as well, so they're not mutually exclusive. Other borrower attestations or certifications is an eligible borrower, similar to the eligible lender, must certify or attest that they will not use the funds to repay or refinance other loan balances or to cancel or reduce other debt of equal or lower priority, with the exception of mandatory prepayments. Erik kind of alluded to this already, but it's unclear to what extent borrowers will be permitted to prepay, existing line of credits or pay down, existing line of credits or other working capital type lines of credits, and something that we'll hopefully get further guidance on moving forward. The borrower will also be required to attest that they require the funds due to the circumstances of COVID, and that they'll make reasonable efforts to maintain their payroll and retain employees during the term of the loan. So this point here is different from Paycheck Protection Program in the sense that it was almost presumed that all borrowers were affected by COVID. And I think that there'll be a heightened level of scrutiny with regards to this program, to the extent the borrowers have to establish that their operations were really impacted by COVID. And in terms of reasonable efforts, that again is unclear to what extent a borrower has to maintain their payroll and maintain their employee count. Other attestations, the borrower is required to meet the EBITDA leverage conditions, which we'll discuss shortly. and follow other compensation, stock reduction, stock repurchases, and distribution requirements that, again, we'll discuss shortly. Finally, similar to the lender attestation, the borrower must satisfy the eligibility requirements, including the conflict of interest provisions. Finally, we get into really what qualifies as an eligible loan for purposes of the program. Fairly limited provisions. We're looking at 4 years maturity, deferred payment of principal and interest for 1 year, adjusted rate of interest to the secured overnight financing rate, plus an additional 2.5% to 4%, a minimum loan size of $1 million, and no prepayment penalty. Some things to keep in mind here with regards to the 4-year maturity is, particularly with the expanded loan program, the potential for there to be a conflict in the terms of this new added facility with the existing facility, and how the program plans to accommodate borrowers who may run into that issue. And another thing to keep note is, although there's a deferment of payment of principal and interest does accrue throughout the term of the loan. And these criteria apply to both Main Street loan programs, both the new loan program and the expanded loan program. And then we turn to some criteria that are specific to the specific program. So with regards to the new loan program, we're looking at, in terms of maximum availability, a cap of $25 million, or an amount that, when added to the borrower's existing outstanding and committed but undrawn debt, does not exceed 4 times of the borrower's 2019 EBITDA. Some potential complications here is what exactly constitutes debt, what exactly constitutes EBITDA, are various adjustments and add-backs permitted, to what extent, if there are certain definitions in that the preferred lender, the eligible lender, likes to use, to what extent will they be able to continue to use their preferred definitions and their preferred concepts for purposes of this program. So these are some things that we hope to get further guidance on moving forward. Additional criteria: maximum loan availability for the expanded loan program, looking at a cap of $150 million. And the maximum amount that can be borrowed is the lesser of 30% of the borrower's existing outstanding and committed but undrawn bank debt, or an amount, again, when added to the borrower's existing and committed but undrawn debt, does not exceed 6 times the borrower's 2019 EBITDA. One distinction here that's different from the new loan program is the reference to bank debt as opposed to debt generally. Potential implications here is that this may exclude non-bank debt from this program, and so it's unclear exactly how this will be applied with regards to existing indebtedness from non-bank lenders. One additional point to note that Erik has already touched on is with regards to the new loan program, to the extent that there is a security with regards to the underlying loan, that security will again serve to collateralize both the underlying loan and the additional tranche that's being added by the expanded loan program. So if one pursues these programs, there are certain restrictions that will apply to both the new and expanded loan programs. The first thing, no stock buyback of equity securities listed on a national securities exchange of the borrower parent, and no dividend payments or capital distributions on capital stock during the term of the loan and for 12 months following the loan. Big distinction between the PPP program is that these loans are not forgivable, which I think has been a big draw for a lot of folks with regards to the PPP program. And then finally, another restriction in compliance with Section 13.3 of the Federal Reserve Act requirements. So the Federal Reserve must assign a value to all collateral to ensure the loans are sufficient to secure the protected taxpayers. And then the borrowers cannot be insolvent as defined by the Dodd-Frank Act. So kind of going back to what Erik alluded to earlier about the requirement of the borrower being in good standing and the increased scrutiny and underwriting requirements of this program. One thing that's not clear and that we're hoping to get further guidance on with respects to the restriction on buybacks, dividends, and distributions is to what extent the program will accommodate tax distributions and other common distributions, the extent that the program will accommodate any existing agreements or obligations that particularly small business owners may have with regards to distributions and earnings of the various equity holders. All of this hopefully will be fleshed out in the coming days. Additional restrictions, again, during the term of the loan and for 1 year afterwards, we're looking at certain compensation caps, officers, employees with compensation in 2019 in excess of $425,000 is frozen. It cannot be increased. Officers and employees whose pay exceeds, again, $425,000 cannot receive severance pay in excess of 2 times their total compensation in 2019. And no officer or employee whose total compensation exceeded $3 million in 2019 may receive additional compensation in excess of that $3 million, or 50% of the excess $3 million of total compensation received in 2019. With regards to what constitutes compensation, we're looking at salary, bonuses, awards of stocks, and other financial benefits. Though it's unclear really at this point how exactly stock awards and certain other forms of compensation will be valued for purposes of this restriction. Finally, with regards to these various restrictions, borrowers will want to, again, consider various restrictions or the covenants that they may have with regards to other equity holders, with regards to their existing lenders, and any other considerations that they may have really with any other covenant that the business may be facing. Finally, the programs have certain fees that are applied either to both the new loan and the expanded loan program, or specifically to just one of the two. So the facility fee, which is applicable only with regards to the new loan program, is not charged in the expanded loan program. It's really a fee owed by the eligible lender to the SPV of 100 basis points of the principal amount of the eligible loan. Note that although it's owed by the eligible lender to the SPV, the eligible lender may and likely will require that the eligible borrower pay this fee. Another fee that is to be considered is the origination of the upsizing fee. This fee is applicable both to the new loan and the expanded loan program. This fee is owed by the eligible borrower to the eligible lender. It's just a fee of 100 basis points, 1% of the principal amount of the eligible loan. And then finally, there's a servicing fee, where the SPV will pay the eligible lender a fee of 25 basis points of the principal amount of loan per annum. So this is the only fee that is a reoccurring fee. The other fees are just one-time fees paid at the outset of the loan. And with that, I turn it over to Erik to finish this off. Thank you.
Thanks, Loic. So moving on, the termination of this new SPV facility, at least based on the initial announcement, press release, and term sheets, is that the Federal Reserve and Treasury SPV would stop purchasing these 95% participations, so basically stop the program from new loan origination with the participation backstop on September 30th, 2020, unless they opted to extend that date. And then even if it did end on September 30th, 2020, the Fed would continue to fund the SPV until the underlying assets are mature or are sold. So its underlying assets are the participation rights. So this would be an ongoing, the term is 4 years. So they'd either be selling off those participations or waiting until they mature. So even though new originations would stop on September 30th, the program would obviously need to continue to be facilitated for a period of time after that on sort of on the back end with the banks, given the participation, significant participation by the Fed and Treasury. Let's go to the next slide, please. Okay, so having gone through the program terms, Loic and I wanted to highlight some just practical considerations, and I think a lot of these will apply regardless of how or whether or how the program terms may evolve in the coming weeks or over the next week or so. I think that's around the time frame that a couple of the Fed representatives have kind of floated out there as maybe the actual implementation date where banks start originating loans or expanded loans under this program. So I think these will apply regardless. So just something to think about in the meantime if you're considering this program. Obviously, you wanted to determine your eligibility as a threshold matter for these programs and kind of what your current borrowing arrangements are, what your options would be for either using the new loan program, the expanded loan program, and just remembering that you have to choose one among the Main Street lending programs. And then we didn't cover the primary market corporate credit facility program, but I believe you could not take advantage. You have to choose one among those three. You can't ride multiple horses here other than the Paycheck Protection Program. So just thinking about eligibility and which is the best fit for you. Obviously, for all of these programs, it's important to review your existing contractual commitments to determine, especially your existing loan arrangements or anything that looks like debt, to determine what, if any, consents or waivers might be needed, but also in general, just what the ripple effects of participating in one of these programs could be. For example, some borrowing arrangements have most favored nation provisions. That may not be all that relevant here, given how pro-borrower a lot of the terms under the Main Street lending program would be. I don't think too many lenders are going to view these terms under the Main Street lending program as more favorable to a lender than what they currently have, but there might be instances where that's the case. So just something to be mindful of. And similarly, while not called out here on the slide, some lenders may have rights of first option, basically, to provide additional debt financing if it's needed. So if that's the case and the lender does not want to provide the additional financing, you need to memorialize that consent or work with them somehow to navigate that situation. But if there's no option for a lender to finance the upsized tranche and there's no most favored nation provisions, then you're kind of looking at your standard thing. Do you need consent? Is sufficient borrowing baskets under your existing facility? One thing to think about is in terms of maturity of loans, if you have an existing credit facility, for example, that you want to upsize under this program, but the existing facility has a term of less than 4 years, and 4 years is the kind of across the board term for all the new Main Street lending program funds. How is that going to work? Does the 4 million, does the 4 year term of the new portion of the facility get shortened down to whatever the maturity of your current borrowing arrangement is? So I think there will need to be some work done there if your existing borrowing borrowing arrangements have a maturity of less than 4 years, how to make those puzzle pieces fit together with, the 4-year term of the Main Street lending program. And then, are there issues where you need to deal with subordination where, you've got additional collateral being provided potentially under the expanded or upsized portion of the Main Street lending program. So just really important to be aware of what are kind of the rules of the road under your existing borrowing agreements, if any, as you're trying to make all this work together, should you proceed with a Main Street lending program, new loan or upsized loan. And then, we've hit on this multiple times already, but just remaining up to date on changes to these anticipated Main Street lending program terms that may get announced by the Fed, Treasury, and then I'm sure every bank will end up having sort of its own implementation protocol. So just staying up to date on sort of the process and substance side, as that has proved to be a moving target in the context of, for example, the Paycheck Protection Program loans. Given the desire to get the money out quickly to borrowers, it's just a very fluid landscape, one that you need to track, at least daily. And if you're if you're a banker or an accountant or an attorney, kind of working with people, probably more frequently than daily. So let's go to the next slide. And a few other considerations. Lenders aren't required to make these loans, even if they are an eligible lender and they can make all the attestations. They don't have to make the loans. So there will presumably be some negotiation with each bank. This will probably be easiest to work through with banks that people already have, or that businesses already have borrowing arrangements with. Clearly, if there's an upsizing of an existing facility, that will be the case. And it'll be easier to make this all work with your existing lender. But even if it's a new loan, probably best to work with, in the first instance anyway, the bank that you have the most commercial ties with for other banking relationships. And then if they're not going to make loans, or if it's difficult to facilitate a new Main Street loan through that bank, then consider working with another bank. But because there's no requirement for the banks to loan, there may be some speed bumps along the way where you got to potentially look to work with different lenders. It's also unclear, kind of what the documentation process will entail for this entire program. I guess it's easier to think about some level of standardization when it comes to new loans. But even there, I think it's very likely that there will be bank by bank variation in what those loans look like, as long as they meet the criteria for a Main Street lending program loan to be an eligible loan for participation by the Fed. But then when you start thinking about increasing the availability under an existing credit arrangement, so the expanded or upsized loans, it's really hard to envision kind of a set of uniform or standardized documents for something like that. So I think clearly in that circumstance, you're going to have some fairly bespoke amendments to existing facilities or restatements to existing facilities agreements to really make this work for any given borrower. And that kind of goes hand in hand with the last point, which is we really need more detail about how this kind of new or upsized portion of a loan is going to work with the pre-existing loan terms, both in terms of maturity, which kind of touched on already, if there were a shorter maturity for the existing loan, but also for other terms. I alluded to this at the beginning of the presentation. Does the interest rate that applies under an upsized portion of a pre-existing loan, is that presumably the interest rate that's going to apply to new borrowings following the adoption of the expanded facility, or is it the interest rate that applies presently and not until you get to the upsize portion do you get the lower rate, presumably? So I think there's definitely a lot of additional detail that needs to be worked out on that front, and we just don't have answers to right now. So let's move on to, I think, the final of our slides with a few other additional considerations. Again, I mentioned this earlier on, but the absence of some of the other potential CARES Act certifications to me was noteworthy, especially those relating to union issues, which was something that was kind of viewed as one of the bargaining points, I think, as the CARES Act was being finalized. The direct lending programs under the CARES Act for mid-sized businesses included some other certifications in beyond just the union-related ones, commitments to not offshore jobs, commitments that are more objective related to retaining employees and maintaining employee compensation, which the Fed and Treasury presumably exercise their prerogative on the basis that this is not a direct lending program to not require those certifications. But it will be interesting to see over the next couple of weeks, just as a political matter, against the backdrop of another expansion of stimulus or a phase 4 of COVID-19 stimulus, whether this becomes a political issue or not. But the Fed and Treasury seem to have come up with a way to do this indirect lending, and I don't think it was motivated necessarily to get around these certifications, but the absence of those certifications, whether that is something that becomes a political issue before the final program terms are kind of set in stone and banks start lending. And that's a good segue into the last point, which is that the Fed is collecting feedback on these kind of initial terms for another few days. And then they're collecting feedback from borrowers, lenders, and other stakeholders, quote unquote. So there will be more changes coming, and potentially Congress could also step in, as I alluded to, as it's working on further legislation related to this, and impose additional terms theoretically on what the Fed has put out there as sort of an initial set of program terms. So a lot of moving pieces, but this is kind of what they've sketched out as the initial framework for the Main Street Lending Program. With that, I think we're at just about an hour. Let me take a look. There's one question. We addressed a couple of questions already in the Q&A section. One was, and I typed in the answers to both these. One was recognizing that the loans basically will have some underwriting occurring. Do these loans have credit elsewhere testing? And the answer to that is that there's nothing in the information release that would require credit elsewhere testing. That's really a Small Business Administration requirement for its lending programs, and the Fed has made no reference to anything like that being a part of this program. So unless something changes there wouldn't be any kind of credit elsewhere testing. But again, it's important to remember that banks are not required to make these loans. So, there may be, maybe that you end up having to talk to multiple lenders anyway, even if you don't have to establish the absence of credit elsewhere. And then I think in reference to the use of the term non-bank lenders, there was a question about whether that meant that credit unions would not be eligible. I believe federally insured credit unions should be eligible lenders, and I did not mean to necessarily exclude them from being a potential lender. When I use the phrase non-bank lender, I meant more of your non-U.S., non-federally insured lenders who have kind of emerged that finance some businesses, have become more prominent over the last 5-10 years. But federally insured banks and credit unions should be eligible lenders. Whether they ultimately make loans or not under the program is a different question, again, because they're not required to make or expand loans. And then there was one other open question, which was if we decide to change lenders but keep terms, would that be reducing or canceling debt? If we decide to change lenders but keep terms, that's a good question. If you're saying like, if we refinance, if we have an existing loan or lending arrangement, but that lender doesn't participate in this, doesn't upsize a loan or expand a loan, and you end up changing lenders, terminate your existing facility or refinance it with another lender that would upsize the loan. I don't think there's a clear answer to that under the term sheets that have been put out. I think the approach you would hope to see is that the Fed would not view that as disqualifying, given the overall goal of this program to get funds out into the marketplace. However, it does press on a point of tension, which is that, at least as to the upsized lending portion, you're really relying on the ability to implement that expanded loan through the existing banking relationship. And the more friction there is with that existing banking relationship, if they don't want to provide the upsizing, the more difficult it will be for those borrowers to access that potential source of debt financing. And it may be more time consuming or expensive for them to get the benefit of the Main Street lending program. So yeah, I think you want to find out as soon as possible if you're going to have an issue with an existing lender, if you're otherwise eligible for an expanded loan, to make sure that you understand if you might need to look at other options. So unfortunately, I can't give a clear answer to that, but I would hope that the Fed would recognize that it would be consistent with the overall objective of the program to allow a borrower in that situation to try to either refinance or seek the loan funding elsewhere without considering that a reduction or a cancellation of debt that would be disqualifying. Okay, those are all the questions in the Q&A box, so thank you. Those are all very good questions, and something we can hopefully look forward to seeing more guidance on. We appreciate everybody who took time to join us this morning and who have taken time to join us on prior webinars as well. It's been a great way to stay in touch with the community and clients and others during these really unprecedented times. So we appreciate your involvement and the contributions you make through Q&A and being here with us. So I hope you have a great day. Loic, would you like to say any final words before we sign off?
Yeah, just to echo all the sentiments that Erik has expressed. We appreciate everyone tuning in, continuing to reach out, and wish everyone the best through these interesting times.
Yeah, thank you, Loic. And yes, if you have follow-up questions on any of this, please feel free to reach out. Hopefully, we'll be able to provide more definitive answers each day that we get more guidance. But in the meantime, we're happy to discuss what we do know about this program. So thank you very much, and have a good day. Take care.